Hello, we're Team FUCAPE from Brazil, and we will present our investment thesis on Tenda. But first, what is Tenda?
Tenda is the second largest popular house developer in Brazil that provides quality house for low-income families through the government social house program Casa Verde Amarela. It is currently focused on metropolitan regions and with growth expectations into new areas. Along with smart and project expansions, the company's industrial approach ensures the highest return on invested capital of the sector.
Since its spin-off in 2011, Tenda had an exceptional growth of net revenue with a 20% CAGR. Besides being fully coordinated in the value chain, its business model is based on higher release, pass-on sales, and on-sales stores.
But for now, let's take a step back and understand how the company is positioned within ESG aspects. Construction projects can have a significant impact on the world's environment. Today, Tenda only complies with environmental legislation. However, the company does not elaborate a sustainability report and does not disclose any of its practices regarding the environmental pillar, making it harder for us to quantify the company's environmental impact. But we do believe that due to its construction strategy with fast and standardized process, and now with the upcoming of the Offsite project, Tenda might pollute less than its peers.
Tenda is listed in the highest level of corporate governance in the Brazilian stock market. It has a spread ownership structure with a free float of more than 90%, with renowned investment companies as relevant shareholders that help to keep up the high governance practice, alongside its highly qualified board of directors, entirely composed of independent board members, and with long and short-term compensation alignment.
However, the lack of diversity is a low point for the company. It does not have any women on the board of directors and only 2 women in the executive committee. On the other hand, Tenda is 100% dedicated to the government's social housing program, Casa Verde Amarela, offering real estate within reach of low-income families, incorporating more than 43% of the Brazilian families. Another strong point is the company's commitment to its employees and clients. Nevertheless, Tenda does not stand out from its competitors regarding ESG aspects. In fact, the company falls behind its peers. Overall, ESG analysis started to gain space recently in Brazil, and this is exactly what we can observe with Tenda. The company has signalized improvements in this aspect, and we believe it will continue in doing so as ESG drivers become a synonymous of a valuable company.
So, is it time to invest in Tenda?
Yes, in fact, the company is building a bright future. We are share buy recommendation with a target price of 37 reais for the end of 2021, resulting in an upside of 37.5%. Our investment thesis is based on 4 main pillars: a promising industry, a different demand perspective, operational efficiency, and offsite expansion.
The segment in which the company operates has a great resilience when compared to the home builder sector as a whole. This is mainly because the demand for popular housing is powered by the program Casa Verde Amarela, which seeks to reduce the country's high housing deficit.
The program is financed by the Workers' Protection Fund, which is supplied by a fixed contribution of 8% of the workers' gross monthly income. Although its revenue is correlated with the unemployment rate, in time of stress, the fund's NAV remains at a satisfactory level.
For the near future, we see a promising outlook for the sector. It is expected a 58% growth in the number of families by 2030. Combining that with a high housing deficit, this stands for a positive impact in the demand, and consequently, an increased need for home building.
Other 2 variables that affect the sector's perspective is the low finance cost and the abundance of credit that has been driving demand for housing. There is a negative correlation between interest rates and the number of unit sales.
Besides a good future outlook, Tenda and the main companies operating in the low-income segment still have a low participation in the housing program. In 2019, the 3 main housing developers had only 15% of the market share of the program, letting plenty of space for consideration in the segment.
And how does the company operate in this market?
When compared to its peers, Tenda has a different position regarding the supply of its products. Currently, the company operates only metropolitan regions with more than 1,000 units demanded per year. That is, with high and constant demand.
But can it be competitive?
Combine the constant demand with low prices, Tenda has a secure sales speed metric, consistent and independent from seasonality. From 2015 to 2020, the company reported an average quarterly sales speed of 27%, with 3.7% standard deviation.
And with that, from 2013 to 2020, the company reached a CAGR of 33% of units released and 24.5% of net units sold.
The third pillar is based on Tenda's operational efficiency.
Tenda has an industrial approach. Using the aluminum-shaped construction method, the company managed to reduce by 19 percentage points the proportion of its cost of construction in relation to its net revenue. Another way to attest the operational efficiency gains is through the return on asset advance, jumping from 1.5% in 2015 to 8.6% in 2019. Therefore, the company is able to offer its units at a price below the market average, considering increasing its sales speed.
But how does this help Tenda?
Besides location, price is the major value when the consumers pick up decision, especially in this segment that has a large price demand elasticity. Thus, since Tenda is well positioned in both aspects, the company is prepared to face the high competition for prices in the sector.
Although Tenda's current constructive method is highly profitable and efficient, the company wants more.
Given the limited expansion of operations in this business model, the company developed a new constructive approach that is capable of reaching a larger consumer market, up to 4.5 million of units, by operating on a smaller scale in small and medium-sized cities. Thus, using industrial systems, the company wants to optimize production for low-demand locations.
In order to reduce the execution risk for this model, the company has recently announced partnership with the Brazilian largest offsite operator, FUCAPE. This may have a substantial impact, speeding up Tenda's learning curve on this work configuration.
This new path is financially feasible only because of the company's strong cash generation and low cash exposure in the current model, given that the financial takeouts occurs before the construction and the company has improved its activity metrics.
But is the offsite project a good idea?
With similar margin to the current model and high scalability, the offsite project allows the envisage of a high long-term growth potential. Hence, the company offers the best of both worlds, growth and value.
Okay, so far we presented a company that is well positioned within the market that it operates, with an efficient method of construction and that is seeking to expand this range of operations. But how does this reflect in our projections for the company?
In terms of launches, we assume a continuation in the expansion through main capital regions for the traditional strategy. For the offsite business, our expectations of growth are more aggressive. By 2030, we expect the offsite line to stand for 45% of the company's revenue, showing the potential for this field up ahead.
Looking for margins, we see pressed gross margins for next years compared to recent trend, mainly due to increased costs of raw material. To model offsite margins, we assume the performance to be equivalent to traditional strategies. But to conquer the offsite growth, relevant capex is necessary for factory building. We expect those to begin by 2021 for the first plant in the state of São Paulo. Another round of capex will be necessary later on to continue the strategy with the second mill.
In our valuation model, we projected 10 years of free cash flow, reaching a valuation of 37 reais per stock. This price implies an upside of 37.5%. Furthermore, in a sensitivity analysis valuing the long-term growth and WACC, we reach a buy recommendation for all but 5 scenarios, assuming a 12% safety margin needed. And moreover, we projected 3 possible outcomes for the offsite segment. The pessimistic one implies a cash burn for capex development and deterioration of margins that reflects a target price of 31 reais. For the optimistic side, we simply follow Tenda's expectations to reach an upside of 67%. This difference of bull and bear scenarios for the offsite project explains the value of this optionality for the company.
Multiple analysis for Tenda give mixed signals. While Lucha price to book value can induce an expensive number, the high return on equity leads to an undervalued position against the main peers in the sector.
But what are the risks on this investment?
Tenda might face a strong competition from land banks in the next years, especially in metropolitan regions, since a substantial part of the company's success is due to acquire great located lands at a reasonable price, and this could affect Tenda's revenue.
A second risk will be a potential increase in interest rate that should eventually lead to less capacity in wealth clients financing their house acquisition, reducing the company's revenue, and a higher debt-related costs. Each one of these points may impact the firm's performance. Thank you for your time and attention, and we're open to questions.
Thank you. Judges, please turn on your videos. Stay muted unless you are speaking. I'll start the time as soon as the judge utters the first word. Time will end at 10 minutes. Please feel free to begin.
Yes, I'll start. So picking up on your last risk point there about higher interest rates being a risk toward profitability and future growth. What is the capital mix of the company? How much debt do they have? How much is short-term versus long-term? So I can assess like how much exposure they may have to a steepening yield curve or higher interest rates.
Well, the company's capital structure today is based on 75% of equity and 25% of debt. And we are looking at market value of both, of equity and debt. So, and most of the debt is concentration over longer term. But in last years, there were some problems regarding the rolling over of this debt. So a larger portion of this is in fact in the short term. So the duration of the debt is around 16 months, but the company is already in good shape to roll over to a further extension of this debt.
Along those same lines, we're seeing a lot of lumber inflation, various commodity inflation globally. How does the company hedge? How do they deal with such dramatic price increases in such a subsidized by the government business?
Well, in fact, the company does not have any kind of hedge for these things. And in fact, in Brazil, the problem is a little bit worse because there was the depreciation of the Brazilian real as well. So the prices of those materials in local currency, in fact, increased a lot, much more than in the US, for instance. And the company, in fact, suffers from this. So the gross margin last year fell by almost 3 percentage points. And we believe that this will continue in the next year. So in fact, this is a difference of our projections in terms of in comparison to the market consensus. And in fact, the company is not protected from this, but it is protected in another way. So it is the low cost play of the segment. So if the company goes worse, all of the rest is going to be much, much, much worse. So this is the path for this side.
So how does the subsidy change in light of underlying changing inflation, or is the subsidy fairly constant?
Oh, Isadora, could you explain that part?
Yeah, sure. So to explain the subsidy, I will have to explain how does the program work. So we actually don't have a lot of subsidy inside the program. So basically the program, Casa Verde Amarela, was built to meet the habitational deficit need in Brazil, which is pretty high, and basically works in this way. There is the families, according to their income bracket and the location, they are put it into, I'm trying to go to the Q&A, but okay. So according to their income brackets and location, they get a fixed mortgage rates. So you have 3 brackets, the 1.5, 2, and 3, and the one that Tenda is only concentrated is the first and the second one. And the subsidy is mainly concentrated on the first bracket and is not that high. The majority part of the house acquisition is actually financed by the Workers' Protection Fund through these mortgage rates. So the subsidy doesn't really play a bigger role in this financing house acquisition.
I don't know if I may jump in. Picking up on the risk, you've mentioned that rising prices of raw materials and inflationary pressure are one of the risks that you have to consider. How do you reconcile that with a gross margin that when you show us gross margins are increasing?
Okay, in the first years, the gross margin in fact is falling. So by 2018, it was 35%. In our projection for the next 2 years, in fact, is around 31%. So in fact, the gross margin have been falling in our projection as well. We believe that this margin, in fact, should go up over later years. So with the inflation going down again, the company should reconquer this lost percentage points in terms of gross margins. You could put to the slide, the valuation part.
And how about the land prices, the prices of the land?
Well, in fact, the company now has a large land bank for the next years, but is acquiring more. And we do believe, in fact, that this is a risk, but again, it's a risk for the whole sector. And Tenda is the best one in terms of selecting and buying the land bank. So we believe that if those prices go up, in fact, it will go up for the prices of the units as well. So it will not impact much more in terms of margins. We believe that the gross margin should be much more impacted by any increase of raw material than in terms of land bank increasing prices.
Okay, thank you.
Thank you.
I want to ask a bit about your sensitivity analysis, obviously with a low-cost strategy here, in addition to some unknowns with the cost gyrations. Can you talk us a bit about some of the sensitivity analysis that you did and what that led to if some of these things you start moving?
Well, in the sensitivity analysis, we vary the WACC, so it is a market perception number, so and as well as the growth over the long term. We believe that this sensitivity analysis, in fact, would show what would be the price of the company if everything went wrong in terms of financial conditions and macroeconomic as well. So we looked at the result reaching 5 whole numbers only as a positive side in terms of our buy, because even if the WACC goes to 14%, which is not reasonable, especially looking at current interest rates and things like that, the company is still a good opportunity for a buy. So the purpose of this sensitivity analysis is that. And we did another one regarding the Offsite project that should have another view, which is what if the operational side of the Offsite went wrong and there is still a buy recommendation. So if you vary the growth, the number of units, the margins, and there is still a growth in the worst case scenario, which is 31 reais. So the purpose of those sensitivity analysis is that one.
You guys have a multiples analysis using a forward PE, and you say it's in line with average. There's 2 years of data there. Is that an average against an industry? Is that an average against historicals? Elaborate on how you use the price to earnings and your valuation.
Okay. The fourth 1 year PE analysis is in fact looking at the companies itself over the last 2 years. So it's comparing with its own average, and we think that it's in line. So, but from then on, Tenda had a much better view from the market. So over 2018, it had much more risks in terms of confirming that it's a capable company for operating alongside and looking for things like Offsite. So this is where the market, the multiples enter, looking at itself and looking to the sector as a whole. We think that in terms of PE, the company is in fact in line with the average, so a little bit above, because it's a premium play of the sector. In terms of price to book, it's in the same line. But in terms of EV/EBITDA and EV/EBITDA, in fact, it's one of the cheapest ones. And this is mainly because it is one of the few companies that in fact operates on a net cash position right now. So it is still looking for multiples, even it's a pretty good play for the sector.
You rely heavily on a discounted cash flow model to justify your recommendation. According to my data, free cash flow declined from $258 million in 2018 to $39 million in 2020 as cash flow from operations fell and CapEx rose. Could you show me how you've modeled that and why you expect a sudden turnaround in free cash flow?
Well, in fact, for the next years, we expect the free cash flow to be low as well. So mainly because of the Offsite coming up and much of the expenditures in terms of mill having a great impact in the first 3 years. So we in fact expect the company's free cash flow to increase only when the first mill of the Offsite matures. So this is around 2025. And then if the model goes correct and in fact is a good call for the company, a second mill should be done by 2027. There is not, again, a large portion of its capex from then on to have a larger free cash flow. So in fact, if you looked at our free cash flow composition in terms of the price, so 27% is in the next 10 years, so our projections, 68.5% is in the perpetuity, and 5.4% is in the net cash position right now.
Thank you.
Talk about political risk. This is a subsidized business. You get regime change, government change. How do you guys think about that?
I'll get this question. So regarding regulatory risks, we do not believe the main risk will be the extension of the program, but we do not take this into consideration because it is it was a program based to meet the habitational need in Brazil, and it has been endorsed by several Brazilian leaders since its inception in 2009. So we do not believe that the program will be extinct. And also, again, about the subsidy, it comes back to what I said before, just a small part of the house acquisition is subsidized by the government. The majority of the house acquisition is financed by the Workers' Protection Fund.
Thank you.